Welcome to the deep dive. It's really something how fast things change. We thought this Jubilee year might be, I don't know, a bit calmer.
Yeah, celebratory even. But nope.
Not at all. It's turned into a full-on sprint. Kind of makes you think of that Lenin quote, right? About decades happening in weeks. If you're out there feeling like the ground's just constantly shifting beneath your feet, well, you're definitely not alone.
Absolutely. I mean, it's the kind of market where what seemed certain yesterday is, well, today's big question, chasing every single headline. That just leaves you dizzy.
Exactly, which is why we're doing this. Today, we're diving into the latest weekly newsletter from the Macro Butler. Always insightful. And this one's got a title that really cuts to the chase. Kiss Me.
And our goal here, our mission for this deep dive, is pretty simple. Cut through all that noise. We want to pull out the really important takeaways from this newsletter, things that actually matter for you as an investor right now.
Yeah, trying to simplify what feels like a really complex picture and, get some actionable stuff out of it.
Right. And the newsletter itself gets straight to it. It lays out this core strategy, kiss me, keep it simple, stupid, minimize entrapment.
Huh. I like that. In this kind of market, simplicity sounds, well, pretty darn appealing, doesn't it?
It really does. And they kick off with a Keynes quote that feels super relevant right now. It's basically a reminder that sticking to old ideas when the facts are changing, that's risky.
When the facts change, I change my mind. What do you do, sir? Seems straightforward enough. But, like the newsletter points out, the real challenge is figuring out which facts actually matter.
Yeah, that's the tricky part.
Especially when you've got, as they put it, the manipulator-in-chief and their social media adding just another layer of fog.
Precisely. Sorting signal from noise is, it's always tough, but it feels especially hard now with so much sentiment and maybe even deliberate misdirection flying around. The newsletter really hits on how contradictory everything feels day to day.
Okay, so to help us cut through that, the Macro Butler lays out 5 big megatrends they see reshaping things. First one, Fortress America 2.0. Let's unpack that. What are they getting at?
Well, this trend is about a pretty noticeable shift, they argue, in U.S. foreign policy. More inward-looking, maybe more self-reliant.
Okay.
And they use some, punchy examples, like hypothetically booting Denmark out of Greenland or China out of Panama. And then there's the rhetoric from figures like the Vice Mayor-in-Chief in Munich or even Oval Office talks about Ukraine.
Right. It definitely suggests the U.S. may be less focused on being the global cop and more in its own interests. So for investors, what are the potential impacts? What should we be thinking about?
Well, if this trend really picks up steam, you could see big shifts in global trade, supply chains, investment flows, a more protectionist U.S., while that could mean more friction, maybe even a reordering of the whole global economic setup.
Okay, trend number 2. The U.S. consumer, not your Atlas anymore. Wow, that's quite a statement. What's the logic there?
Yeah, it is bold. The traditional thinking is, the American consumer drives everything globally. But the newsletter argues that things like these new Liberation Day tariffs.
Which they call Liberation from Your Wallet Day, right?
Exactly. Funny, but probably true for many. They argue these tariffs are likely to squeeze consumer spending.
Makes sense. Tariffs aren't exactly stimulus for shoppers. And they also mentioned trade wars, suggesting it's maybe a long game where China has an advantage.
That's right. They call it a war of attrition. The idea is China's longer-term view might give them an edge over the U.S., especially with our shorter election cycles. They even put in a chart comparing U.S. retail sales, adjusted for inflation, against the U.S. misery index. It sort of hints at the growing pressure on American wallets.
Okay, let's shift to the third megatrend. AI, the not-so-golden goose. Now, this is interesting, given all the, breathless hype around AI lately. What's the Macro Butler's take?
Well, they acknowledge the potential for massive profits, sure. But they argue that China's really stepping up as a major player now with things like DeepSeek. And that changes the game.
How so?
It means those near monopoly type profits we saw in past tech booms.
Yeah.
Probably less likely now. It's just a more competitive field.
So the idea is that the Maleficent Seven, as they call them, they won't have that same clear run they might have hoped for because China's right there.
Precisely. They're suggesting these big U.S. tech names will face much tougher competition from China's industrial scale and, their different approach. There's even a chart comparing the Mag 7 to the rest of the S&P 500 and inflation, maybe hinting that their paths could diverge.
Interesting. Okay, fourth trend, heading east, Beijing stimulus bonanza. So while the West is maybe tapping the brakes, China's hitting the gas.
That's the picture they paint. They contrast the sort of cautious wait and see in many Western economies with China actively using fiscal and monetary stimulus. They're really trying to boost their domestic economy.
And they mentioned this Valerie Pierres circle. What's that about?
Right, that's a concept basically grouping Russia's resources, China's manufacturing, and India's consumer base.
Yeah.
The idea is this geographic concentration could really reshape how global commodities flow.
So China's actively stimulating, and this potential block could shift global dynamics. They've got charts on China's retail sales and credit impulse showing this activity, right?
Yeah, exactly. It highlights this proactive stance, which could have pretty big ripple effects on global demand and commodities.
All right, fifth and final megatrend, de-dollarization and the great asset exodus. We've heard whispers about de-dollarization for a while, but they're saying it's real now.
That seems to be the core message here. It's not just a fringe theory anymore. They're suggesting we're seeing a tangible shift away from the U.S. dollar's complete dominance and also investors moving out of traditional safe bets like U.S. Treasuries, maybe even some of those big Mag 7 stocks.
And they connect this to trade wars potentially becoming capital wars. That sounds concerning.
Yeah. It does. The idea is that using the dollar for sanctions, plus worries about the huge amount of U.S. debt and, frankly, stubborn inflation, all that is pushing countries and investors to look for alternatives faster. They show a chart comparing the dollar index, DXY, and gold, which is pretty suggestive.
Okay, so that leads us directly into their focus on gold. The argument seems to be treasuries are losing their shine, so people are turning to gold. What's the main driver?
It's really a few things coming together.
Yeah.
They point out how the bond market didn't rally like you might expect after things like the Liberation Day tariffs.
Yeah.
That might signal, less faith in treasuries as the ultimate safe haven.
Okay.
Then there's the whole weaponization of the dollar, like we mentioned, and this ongoing inflation threat. They call it Trump stagflation, which is memorable. All that makes traditional bonds less appealing.
And gold is seen as the refuge from all that.
That's the argument. Gold has no counterparty risks. It can't really be manipulated politically in the same way. And, well, it's got a 5,000-year track record at stored value. There's a chart showing gold's performance adjusted for inflation against stocks and bonds since early 2022, and it makes a strong case. Plus, just the sheer amount of U.S. debt makes people nervous about holding more and more treasuries.
And it's not just government debt they're worried about, is it? Corporate debt comes up too.
Oh, yeah, big time. They highlight this looming wave of corporate debt rollovers, especially in the second half of this year. It's left over from that 2020 borrowing binge, remember. A lot of companies loaded up on debt, often for buybacks.
Right, when rates were super low.
Exactly. But now, with rates higher and credit spreads potentially widening, refinancing that debt could be a huge problem. It could really squeeze companies.
So it feels like a lot of these trends are sort of pointing towards gold being more attractive.
That's definitely the central idea. Declining trust in the usual safe assets, geopolitical jitters, plus big buyers like foreign central banks and China reallocating reserves. It all adds up to a pretty bullish case for gold, according to the newsletter.
But they also raise a tricky point about affordability for the average person.
Yeah, and this is really quite stark. They point out that the number of hours an average U.S. worker needs to work to buy just 1 gram of gold has more than doubled just since 2020. Went from about 5 hours to over 11 hours.
Ah.
So yeah, while gold might be a good hedge on a macro level, it's getting harder for regular people to actually access it.
Okay, let's broaden out a bit. They're also bullish on commodities generally, not just gold. What's behind that view?
The main idea there is this potential unraveling of the U.S. security umbrella. In a world that feels less stable, less predictable, countries and companies are likely thinking more about stockpiling essential stuff.
Shifting from just in time to just in case.
Exactly that. Moving away from super lean supply chains to having buffers. And that increased demand for raw materials, possibly combined with supply issues, means inflation might not just be sticky. They say it'll be like Velcro.
Velcro inflation. I like that image. They even show a chart of the Bloomberg Commodity Index adjusted for inflation, right?
Yep, underscoring that potential long-term trend.
Now, interestingly, they also seem to push back on the idea that China's about to collapse. They actually see opportunities there.
They do. They argue that, yes, China has economic challenges, especially around confidence post-COVID. But fundamentally, Chinese companies are still very competitive globally.
Okay.
And with all the stimulus measures Beijing is putting in place, there could be a significant rally in Chinese stocks once sentiment improves. They highlight the historical connection between China's credit impulse and its equity market performance.
And within China, they pinpoint specific areas, like corporate debt and banks.
Yeah, they acknowledge the risks in Chinese corporate debt for sure, but they see potential for big upside if you can pick the right companies benefiting from the stimulus. And state-owned banks are mentioned as potentially attractive too. They're central to Beijing's plans and often pay decent dividends. Again, charts are provided to back this up.
So pulling it all together, the newsletter seems to be saying, look, this Jubilee year was always going to be disruptive. Adaptability is absolutely key.
That's the message. And that KissMe principle, keep it simple, stupid. Minimize entrapment. It's about avoiding ego-driven bets and really understanding the deep underlying forces, the real art of the trade and the art of war, as they put it.
And to help with that, they suggest watching 3 specific ratios against their long-term averages. S&P 500 to oil, gold to bonds, and S&P 500 to gold. What do these tell us?
They're basically like market dashboards or signals.
Yeah.
S&P to oil gives you a sense of growth focus versus energy cost concerns.
Mm-hmm.
Gold to bonds shows the preference for gold versus traditional fixed income, that safe haven fight.
Yeah.
S&P to gold shows risk appetite versus the ultimate safe asset.
Got it. And the big theme running through all this seems to be shifting focus from return on capital to return of capital. Preservation first.
In this environment, they're saying prioritize not losing money. Own real, tangible assets like physical gold and silver plus other commodities. And for the cash part of your portfolio, manage it actively, short-term, high-quality corporate bonds, T-bills, keep it stable.
And for stocks, any specific advice there?
Yeah, they favor companies with low debt, strong earnings, strong free cash flow, and lean towards energy and commodity producers rather than companies relying purely on the consumer.
Okay, let's boil it down. What are the absolute key takeaways from this KissMe newsletter, if you remember just a few things?
Okay, number 1, keep it simple. Kiss, focus on the big trends, ignore the daily noise. 2, recognize treasuries are losing appeal, gold is gaining. 3, watch corporate debt risks they could drive more gold demand. China's buying gold, but it's getting pricey for the average American. 4, expect commodity stockpiling and that Velcro inflation. 5, don't write off China. Stimulus could spark a rally. 6, focus on return to capital, think preservation in potentially stagflationary times. 7, gold and silver are hedges against government actions and maybe collective mistakes. 8, long-term treasuries look unattractive right now. 9, fixed income is actually the riskier part now. Stick to short-dated, high-quality stuff if you need it. 10, expect more volatility and maybe dull returns after inflation.
That's a lot, but clear. And finally, how do they suggest actually trading this? What are the actionable recommendations?
Well, they think the U.S. is currently in an inflationary boom, but it's probably nearing a bust phase. The S&P 500 to gold ratio dropping below its average is a hint. The advice, stay calm, use the data, watch for the shift.
And historically, what happens during that shift?
Typically, you see things like the Dow outperforming the NASDAQ, energy beating tech, and those magnificent 7 names facing headwinds. Physical gold, they stress, is that rock-solid wealth preserver through it all.
What about the dollar?
Near term, maybe still strong against other fiats. But longer term, they see this shift towards a world where Russia, China, India, that Valerie Apira circle idea become more central. And crucially, they emphasize the unique thing about physical gold held outside the system.
Mm-hmm.
No compliance hassle, no digital ID needed, no counterparty risk. It's truly autonomous.
So the bottom line from the Macro Butler is simplify, watch the big trends, and maybe give gold a closer look. Definitely food for thought. What's one final idea you'd leave folks mulling over?
Just this. Think about what it means if physical gold, something tangible offline, outside government reach, starts feeling like a more secure and independent way to hold wealth than digital dollars or traditional bonds. What does that shift in trust imply about where we're headed and how you might want to position yourself?
A powerful question indeed. Thanks for breaking all that down with us. Until next time on